I just wanted to take a second to discuss something because there are a lot of people I know online saying, don't worry about the rate at the time you buy your house. You can always refinance if the rates come down, marry the house, date the rate, that sort of thing. And it is true, historically, we're in a cyclical industry, so we are going to see interest rates rise and fall, and there will almost certainly be an opportunity to refinance your home. All the experts, including myself, are expecting to see rates come down in the next 12 to 24 months. But with that being said, I don't think that's the only way to look at things. I put together some rough figures here based on a $750,000 purchase price, used the base tax rate of 1.25%, which is the base tax rate in San Diego, $100 a month for insurance, and I threw in $200 for HOA just for the sake of it. Just so you know, I put together a comparison for all my clients when it comes time to lock their rates so they can see the rate that's available at par, basically no discount points being paid, versus lower rates that are available and the associated costs with them. I show what the monthly payments are, and that includes everything, principal and interest, taxes, insurance, and even HOA dues that are billed and paid separately so that my clients know what's coming out of pocket. Then I show them what the savings is each month versus that par rate and how many payments they'd need to make in order to recuperate the money they invested in buying down the rate based on that savings if they did choose to buy down the rate. And this helps them make an educated decision based on how long they'll be in the house before they sell or refinance, or at least how long they think they'll be in the house before they sell or refinance. So what people aren't talking about is the fact that refinances aren't free. There's a cost associated with doing them. So even if it's $4,000 or $5,000, people don't work for free. Most often when you see that someone's offering a no-cost refinance, what they're actually doing is providing you with a higher interest rate that allows the bank to give you a credit, often referred to as rebate, to cover those closing costs. If you're refinancing and doing a rate and term refinance to lower your interest rate, this is going to be a hindrance to that. It doesn't make much sense to look at taking a higher rate that's going to cover your closing costs when the whole point of the refi is to lower your rate and payment. Another thing that people aren't talking about is the amortization schedule of a mortgage. They are very interest forward. So if you refinance after a year, it's like $45,000 that's going to be erased and you're going to reset your mortgage back to 30 years. If you wait 2 years, it's over $90,000. So if you refinance in the next year, you're going to be resetting your mortgage back to 30 years and essentially throwing away that $45,000 in payments, of your payment that went toward interest. Unless, of course, you refinance into a shorter term, but that's going to cause your monthly payment to go up, which again is the opposite of the reason that someone does a rate and term refi. You're looking at throwing away that interest plus the cost of doing the refinance. So maybe you're better off looking at spending money up front to buy down your rate, get your payment down, and not having to worry about resetting the clock on your mortgage because of the way mortgages are structured and how interest forward they are. We won't have to cross our fingers and hope that rates come down, and then we could refinance in the shortest amount of time possible. And that's a big part of what I like to talk about with my clients. Now, with that said, I will show you a way that refis might make sense as well. If you're comfortable with the payment at the time you buy, then when rates do come down, you can refinance and make additional principal payments to reduce the time it takes to pay your mortgage and drastically reduce the amount of interest you pay. In this example, I'm using the minimum improvement of 1% in this example. And that's usually when it makes sense to refi if you're lowering it 1% or more. So if the rate comes down 1% and you save about $405 a month on your monthly payment, you take that money and put it back into your payment as additional principal payments, and you can get the loan paid off in just 22 years, obviously plus however long you had your original mortgage. And this could be great. But the reason I strongly disagree with people who are on that train saying, don't worry about it, housing values go up, don't worry about the rate, just buy, is that I understand that there are people out there who are stretching their budget to make a mortgage work, and they really need rates to come down to live the lifestyle they desire. So when they refinance, they don't have the money to make additional principal payments, and they just enjoy the quote-unquote savings that they get from the refi. Now, if you've got any questions or if there's anybody you think that could benefit from this, feel free to share it or reach out. I'm happy to have a conversation. I really appreciate it, and we'll talk soon. Have a great day.